Joining us on the phone line from New York is Geoffrey Dennis, Head of Global Emerging Markets at UBS Investment Bank. Geoffrey, good morning. Thanks so much for joining in. Would you view this as a bit of a blink from the US administration? And if so, what would it mean for various asset classes which are right now rejoicing this bit of a pullback from the US?
I don't think it's a bit of a blink, to be honest. I think perhaps the U.S. administration was surprised at the severity, so to speak, of the Chinese response to the U.S. tariff announcements. In other words, it was a genuine tit-for-tat matching, obviously, what the U.S. administration had done, which is imposing 25% tariffs on $50 billion of imports. But I think this was always part of the ploy here to try to encourage everybody to get to the table and sit down and try to negotiate this. And I think as the day went on, markets were beginning to get used to that as a reasonable outcome. I think it would have been more difficult and more dangerous if China imposed higher tariffs or a higher cost, so to speak, in terms of tariffs than the U.S. had imposed. There is also the point, which I'm sure you're aware, which is that even the U.S. tariffs are not going to come into effect for several weeks. There is a review process. People can make testimony about the tariffs. So even the U.S. tariffs themselves, let alone the Chinese tariffs, may not even be imposed at all. And so I think there's the reasonable assumption now that we're going to hopefully have some sort of at least talks about these tariffs, even if we're not sure if we'll yet get a resolution.
So it remains a fluid picture, Jeff, and which is why the question about what would markets do, because as of now, markets are working sans any direction, up a day, down a day, and with reason, because the news flow is very, very volatile. What do you think markets do in the interim period?
Yes, it's very, very fair point. The news flow is very volatile, and of course, everyone's worried about the volatility of statements coming out of Washington, D.C. as well, and reacting to those. Now, I think as things stand at the moment, the impact of 25% tariffs on $50 billion of imports into the U.S. economy or into the Chinese economy on economic growth is really very small indeed. We think around 0.1% maximum on growth in both economies. So it's not that big, even though obviously the concern would be further escalation from that. It is also, in both cases, something that generates a pickup in inflation, which I think would be a concern also if you were to get a significant pickup in inflation. But again, the tariffs as they're announced so far really don't have that big an impact on inflation. And I think what's interesting about it now is the extent to which some very sensitive products have been brought into this tariff story. Soya beans for China, aircraft, for example, autos and auto parts. Now, if we end up, which is really what our base case is here, that you don't get a further escalation of this in time, you either don't get these tariffs at all or these tariffs are the end of the process, we think this will turn into a buying opportunity for emerging market equities, which of course is what I cover. And we actually think the fundamental drivers of EM, which are, in our opinion, positive, strong global economic growth, reasonably benign financial markets in terms of interest rates, bond yields, and the dollar. We think those are still intact. But the risk is obvious. If this tariff process escalates, you get more tit-for-tat, more tariffs imposed, then you would really have a threat to the global economy. That's what we all hope will not happen. And frankly, that's what we think. We don't think that will happen. But of course, that's the risk. Until we know that, the markets will, I think, probably remain relatively nervous.
Geoffrey, hi, good morning. This is Menaka here. What's your view on the dollar and how you expect that to react, in the months to come, not just to the sort of various impulses from this tariff war situation, but also from the underlying strength and growth in the U.S. economy?
Yeah. Well, first of all, our view is that a lot of folks out there think that the heightened trade tensions is bullish for the dollar. We don't actually agree with that, particularly because we think the dollar is still overvalued. It's still got the U.S. has got a very large current account deficit, which is going to be largely unaffected by by this tariff policy, etc. And so even if you were to see some more tariffs, we're not sure it's going to push the dollar higher. In fact, our view continues to be the dollar's going lower from here. We think we've got it going to 130 against the euro by the end of the year. And that's really because we think the dollar's still overvalued, and we also are aware, of course, of the large U.S. current account deficit, the large current account surplus that exists in Europe, for example. So our sense is, as you go through the year, assuming, as I say, this world trade situation does not deteriorate out of control, is that you will see some benefit for emerging markets coming from renewed weakness in the dollar. Dollar's been pretty stable for the last several weeks, frankly. We see it going lower again, which will generate currency gains for investors in overseas markets. And so we think the dollar's path from here over the rest of the year is going to be a mild positive for EM equities.
Geoffrey, I don't know how closely you look at India, but there is, of course, this monetary policy event as well today. Foreign investors have of late not been allowed to, and in certain cases even shied away from buying Indian bonds. What's your view here?
Yeah. Well, we certainly think that foreign investors in terms of equities, which is what I cover, have really been taking money off the table in India for quite some time. I think you will know on the show that India, for quite some time, 2 to 3 years ago, was by far the biggest overweight that foreign investors had in terms of emerging market countries. Those overweight bets have really come down significantly, although we tend to think probably net people are still probably modestly overweight. What we think, frankly, is that the market is too strong. We think it's been driven up too much, or was driven up too much last year by local money essentially coming out of the property market. The earnings momentum was poor, and therefore we got ourselves in a situation, I think, where valuations got too high in a market where, as I say, earnings momentum was not good, which is very much against the trend of emerging markets around the world. Now, India's had a tough start to the year, so we're beginning to get valuations getting back to something a bit more reasonable, but we are not sure yet that this is the time that investors should be going overweight. We're technically actually still neutral in India in terms of our view. In terms of the RBI, we think that policy will be on hold through this fiscal year, financial year, to the end of next March. But if there is a risk to that call, it's that rates may have to go up at some point. But the inflation numbers most recently, last month or two, have been a little bit better, and I think that does make us feel that the most likely outcome here is flat interest rates over the rest of the fiscal year, which obviously is a positive.
Geoffrey Dennis, thank you so much for joining us this morning on Bloomberg Quint. As Jeff pointed out, the policy is the big event today.